Hello, everyone. Welcome back. Are you ready to face another day here in one of the most fantastic countries in the world on a beautiful summer morning? You can't possibly be in a bad mood now when I start the video featuring a picture I snapped of little Marty when he was a puppy. No one can be in a bad mood now. But like the true Canadian I am, I must apologize right away. I'm sorry, everyone. I'm going to have to share some more good and positive news with you. Our Prime Minister Mark Carney and the Premiers met on Monday in Saskatoon where they discussed nation-building projects. And the reaction was overwhelmingly positive, prompting Doug Ford to say this has been the best meeting we've had in 10 years. And he referred to our Prime Minister as Santa Claus. And I suppose Santa Claus is always counted on to bring presents, and presents cost money. And I'm sure that a lot of the things that were discussed in this meeting are going to have a high price tag. And it is Mark Carney's plan. He has been quoted in saying that when you are met with a crisis, you have to face it with overwhelming force. Does that mean overwhelming spending? And will that result in increased deficits and increased debt? Well, I already know what the Conservatives' position is going to be on this if in the future we do see higher deficits and an increase in our debt. Let me just summarize their position on this. After 11 years of Liberals, Canada is broken, deficits are out of control, the debt is out of control, not to mention the violence and chaos in our streets, and we need an election, an axe-the-something election right away. That pretty much summarizes what you will hear from Mr. Poilievre if deficit levels and debt levels increase as a result of some of the spending, or as Mark Carney would label it, investing, that will happen in the future as he tries to replace the drop in demand of our major exports to the United States with an increase in demand of those very same products through nation-building projects in our own country. And you'll hear the opposite from the economically illiterate president of the country just south of us, as he describes his economic policies as ushering in a new golden age, and how the word tariff is a beautiful word, and how his economic policies are so dynamically and intricately complicated that the math behind them cannot be understood by us mere mortals in the rest of the world. Everyone knows that the president of the United States is a mathematical genius. He's displayed that many times.
Or they give you 6 names in a row. I took a lot of heat on this. They give you 6 names in a row at the beginning. Sir, I'm going to give you 6 names. Good. They look at them. A chair, a hat, a badge, a necklace, and they vote. Those things. We're going to give you 6 things. And I say, good, what's going on?
I don't know, it confuses me, Marty. My brain is just not capable of understanding such high-powered advanced mathematics. So let me share some data with you that helps explain the very complicated topic of deficits and debts and how their levels with respect to GDP, whether it's a healthy economic situation or not a healthy economic situation, it's much more complicated than just shouting out that it's broken. And I apologize to my viewers in Australia. I know I'm covering your island, but let me make the point here. This particular map shows the countries of the world and their debt to GDP ratio through time. And we're going to highlight the G7 countries here and just read off the numbers, and then I'm going to explain what they mean. So starting with the UK here, the United Kingdom, their debt as a percentage of their GDP, so their total debt as a percentage of their gross domestic product, the value of all goods and services, a measure of how large their economy is 101%. So their debt is about the same as their GDP. France's debt to GDP ratio is 110%. Italy's is about 135%. And Germany's is 62%. That's the lowest in the G7. And I'll point out that I'm getting this information from the IMF Data Mapper website. Japan's debt to GDP is 249%. The United States' debt to GDP is 123%, and Canada's debt to GDP is 107%. Now, high numbers are generally bad, and low numbers are generally good. But this is a snapshot as of 2023. Let's go back to the year 2000 and see how things stood. In the year 2000, the United States' debt to GDP stood at 54%, meaning their total debt level represented only about half the value of their total economy. In Canada, our debt to GDP in 2000 was 80%. Now, the United States economy has grown much faster in those 23 years than Canada's economy, but the United States debt to GDP ratio has grown so much faster than Canada's has going from 2020 back to 2023 now, it's grown from about 50% to 125%. Canada's has grown from 80% to 107%. Our debt to GDP is growing much slower than the United States. And this is going to present a huge problem for the United States going forward. What the United States seems to have a problem with is balancing taxation and spending. And they want to have low taxes. And in fact, right now they're working on another massive tax cut bill. So I'm going to show you some data now that paints a very positive picture for Canada and adds another layer of information that you can put on top of this debt to GDP ratio. And that is interest rates. And you can see the graph behind me is from the website Trading Economics, is the United States 2-year Treasury bond note yield. And the yield is the interest rate that investors would get if they buy this 2-year bond. Over the past 6 months, the 2-year yield has gone down from hovering around 4.2% down to about 3.9%. It's come down a little bit, but not as fast as Canada. Here's the same graph for Canada, the Canadian 2-year bond yield, and you can see that it has come down from about 3%. It was lower to start off with, and has come down to 2.6%. So Canadian 2-year rates sit at about 2.6%. The US ones sit a little bit above 3%. Why is that? Now, according to the President of the United States, the reason is this, and I'll read his quote directly so I don't get it wrong. "Too late Jerome Powell is a fool who doesn't have a clue." Jerome Powell, pictured right here, is the chairman of the Federal Reserve. It's his job to adjust interest rates in the United States. The overnight Fed rate is what he has control over. And those 2-year bonds track very closely the overnight Federal Reserve rate. And the reason that the chairman of the Federal Reserve or the Bank of Canada governor would increase or lower interest rates is to either stimulate or restrict the economy based on all the economic news to try and keep inflation in an acceptable band. So why does the president want interest rates to come down? Well, obviously lower interest rates stimulate the economy, but also the United States facing a mounting debt problem, they're concerned about how to service that debt, how to keep paying the interest on all the bonds they have to sell to finance their debt. But of course, it's much more complicated than just berating the chairman of the Federal Reserve. And I might point out that Pierre Poilievre also went through this phase of berating the governor of the Bank of Canada and threatening to fire him. Servicing the debt is much more complicated than just the Fed increasing or lowering interest rate. Here is a 10-year graph of the US 2-year Treasury bond. And you can see that it closely follows the policies of the Federal Reserve, dropping down in between 2020 and 22 when central banks around the world lowered interest rates to almost zero, but has since shot up, hitting a high of 5% and now sits at 3.9%. The same is true for Canada. This is the graph for Canada's 2-year bond. Same shape. You can see that between 2020 and 22 was down close to zero. It spiked close to 5%, the same as the US, but our interest rates and our 2-year bond yield has come down much faster than in the United States, sitting at about 2.5%. But these 2-year interest rates really don't have a lot to do with servicing your debt for your country. Let me show you some more graphs. This is a graph of the 10-year bond in the United States, okay? The yield of the 10-year bond. Now, when a country is trying to borrow money because they're going to go into deficit, they need to borrow more money, like the United States does all the time, they try and sell bonds to investors, usually other countries or large investment institutions. And when they do large issues trying to raise a lot of money, it's typically the longer term bonds that they sell, the 10-year, the 20-year, and even the 30-year bond. And if you look at the yield of the United States 10-year bond, you'll see that since 2020, the interest rate on the US 10-year bond has gone up and stayed stubbornly high, up at around 4.5%. The United States 20-year bond yield is close to 5%, and it's on an upward trajectory. This means that when the United States wants to raise more money, borrow more money from others to fund their deficits for the year, they're probably going to try and sell 10 and 20 and 30-year bonds, and the amount of interest they have to pay to people they want to borrow from is in that 4.5% to 5% range, which has gone up by a factor of 500% since 2020. And for those of you who still don't appreciate the significance and importance of these numbers and these trends, behind me now is the yield on the 30-year US bond. And this is a graph that dates back to 1985. And look at the trend here. From 1985 all the way to 2020. What is that? 35 years? the yield on the 30-year US bond has been declining on a steady declining rate. The United States has enjoyed an environment where it's easy for them to continue to borrow. For 35 years, investors have been happy to buy US long-term treasury bonds, feeling perfectly safe and secure owning these. And in fact, in times of trouble, when we've had economic slowdowns or recessions, you can see spikes down in the yield when investors use these US bonds as a flight to safety. But since the economic shock caused by the pandemic in 2020, when you can see that these bond yields hit their lowest over this whole graph, the trend has completely changed. And now the trend has been going up for 5 years as US debt levels skyrocket. This trend is unsustainable for the United States, and it could really compromise their ability to keep borrowing and to keep growing their debt. And now I'm going to explain why I showed you Japan's debt to GDP ratio being the highest of the G7, something like 240%. How can they maintain such a high ratio of debt with respect to the size of their economy? And it plays out here in the interest rates. This is a graph of the Japanese 10-year government bond yield over the past 10 years. And you'll see that in 2020, that bond yield was hovering just around zero, just like every other G7 country. But rather than increase rapidly like in the United States, the yield on the Japanese 10-year bond is around 1.5%. That's less than half the yield of the United States. So if you're just trying to do some simple math in your head, if you're paying less than half the interest rate, you can borrow twice as much and it costs you the same. Japan can carry a much higher debt at a much lower cost than the United States. Now their trend is going up and they may have to start worrying about this soon. Which brings us to the same graph for Canada, the Canada 10-year government bond yield. And once again, you can start at 2020 when that 10-year bond yield was just a little bit over zero. And ours has increased just like every other nation's, but it kind of stopped going up in the year 2022 and has stayed pretty much flat now, with the yield on our 10-year government bond being just a little over 3%. That's significantly lower than in the United States, about 1.5 points. 1.5 points from 4.5 is approximately, okay, when we do approximately on this channel, we have to get the numbers right. So the United States 10-year bond is 4.46. The Canadian is 3.26. 4.46 subtract 3.26 is 1.2. 1.2 divided by 4.46 is 0.269, approximately 0.27. That means the interest that we have to pay on any new 10-year government bonds that we issue to fund deficits is going to be 27% lower than in the United States. This is the yield of Canada's 20-year bond, and you can see that since 2022, it's been fairly flat, once again at about 3.4%. Remember that the US 20-year bond yield was on an upward trajectory and was close to 5% now. So what the Canadian government can do when it wants to raise money to fund deficit spending is it can issue bonds, and it can pick a certain bond where they feel the interest rate is competitive, where they lock into the lowest cost to finance our long-term debt. And the United States is finding itself running out of options. This is now the United States 30-year bond yield, and it too is on a steadily increasing trajectory, hitting around 5% right now. Now, why is this the case? Why are United States long-term bond yields going up? And I assure you, it's not the case that it's too late Jerome Powell is a fool who doesn't have a clue. That's not the reason. The reason is that when you extend the time period that investors have to hold a product before they get their money back, there's a risk premium that gets built in there. And investors today are demanding a higher interest payment to offset the risk of holding the US bond for a longer period of time. Investors are feeling that holding US assets for a long period of time now has more risk, and they're starting to demand more return for holding those assets. Another factor is this. This is a graph of the value of the United States dollar versus a basket of currencies around the world since Donald Trump became the president. And you can see that in January, that value was about 110. And it has steadily decreased to hovering around 99 right now. So it's dropped 11 points on 110. It's dropped 10%. The value of the United States dollar has dropped 10%. So investors that are thinking of buying US bonds, especially US bonds that they may have to hold for a long period of time, denominated in US dollars. If this trend continues, they're worried about that, so they're demanding a higher interest rate. This is a graph of the Canadian dollar versus the US dollar since Donald Trump has become president. And you'll see that our dollar, in January, it hovered at a value of around 69 cents and has had a steady increase to right now, it's trading close to 73 cents US. These trends are not reacting to the rhetoric that they hear from politicians, the constant doom and gloom about Canada that we hear here from the Conservatives, or the new Liberation Day and Golden Age rhetoric that you hear from the United States president with respect to their country. These numbers and these graphs represent the true feeling of investors around the world as they move their money around to try and decrease their risk and maximize their returns. And what we're seeing is the Canadian dollar heading up and the US dollar heading down. US borrowing costs going up and Canadian borrowing costs staying steady. Canada now is in a much better starting place with a debt representing 107% of its GDP compared to the United States that is already at 123%. And I've moved my head now so the viewers from Australia can see that their country's debt to GDP level is a very low 49%. Well done to Australia. But Canada is in a much better starting position than the United States and a very good starting position compared to the rest of the G7. And the cost for incurring more deficits in Canada is going to be lower than that in the United States because our interest rates for our longer term bonds are lower and they're trending lower while the United States are trending up. This is more good, sound, fundamental mathematical news, and is another reason for Canadians to be cautiously optimistic. Despite what we hear amplified in the media and online all the time, the doom and gloom on the one hand and the musings of an economic simpleton on the other, Canada is doing not so bad and our future looks good. So in the coming months and the coming years, when deficit levels are published, and I do anticipate that Canada's deficits will increase in the short term while we embark on these nation-building projects, they're going to cost money. Remember that when you're comparing a deficit number between Canada, the United States, or Japan, or any other country, there's a lot of other factors that influence whether those debt and deficit levels can be carried and maintained. And it's a lot more complicated than just shouting a slogan about the number. Canada is in a much better position to finance spending compared to many other countries in the world. As you can probably guess, it takes me a lot of time to put these videos together. I take great care in going over the data and checking it from various sources. I believe it's more important for us to see real data rather than just hearing repetitions of what politicians say. I think we can end up being more informed that way and less manipulated by the more mainstream media. If you appreciate the content, consider becoming a channel member. And for less than the cost of one latte per month that you would have to buy at a US coffee shop, you can support this channel, an independent media channel that focuses on Canadian issues and topics that are important to Canadians. Or simply subscribe to the channel to help the channel keep growing. And I will catch you all on the next one.